Hi everybody, Todd here with Trader on the Street. We are going to do a quick overview of one of the indicators that I think some of you have been familiar with, but some of you may not have, and it's called the envelope indicator. And we'll talk a little bit about what that is and let you see how this can help you identify the best times to enter into a trade and knowing when to get out. So with that, let's jump in and take a look at what this indicator is all about. Alright, the first thing that we want to do here, guys, is we want to look at this indicator. So I'm going to go to my indicators. We'll go in here, actually. I'm going to right click on the chart and go to indicators so that you can see what we have here. We really have two indicators that are set up. It doesn't need to be that way because the 50 period envelope. So if I got rid of this 50 period simple moving average, it gets rid of this middle line, and so that's why I like to have this indicator on here. And so we're going to go up and go to the indicators, go to simple moving average, SMA, and we're going to put 50, and we're just going to click OK. Now we've got our three lines here. If we wanted to go in and make this a little bit fancier, we could go in and we could change that middle line to looking like a different color than the other two. So let's go in, we'll go to the series, and under series we can choose what color we want. In fact, we may even make this a little bit bigger at a 3, and we're going to go ahead and change the color to a bluish color on here, and we'll click OK. Now we got a blue, and then we got the top line is green and the bottom line as a red. Now what we're going to be using this as is an area where we're going to be looking for the trend to help us identify when to get in and out of a position. And so we call these sometimes high probability areas, and these high probability areas are the things that are going to allow us to know the best possible time to get into a trade. So we're going to pull out a couple of examples here, and I'm just going to put in some arrows. You'll see these arrows show up here. We're going to look at we'll go with our up arrows here. Actually, we'll go with a down arrow here. So we've got 1, 2, 3, 4. Right there's a down one. 5. That's pretty much the short entries, and we'll look at the long entries here. Really kind of right here. The up arrows are going to be our long entries. Right in here and right in here. Okay, so it may be kind of hard to see, but we've got really 1, 2, 3, 4, 5, 6, 7, 8 trades here. This is an hourly chart of the pound dollar. Now it doesn't really matter what chart you're looking at, because you can look at a euro dollar or a non-US pair. You can look at different time frames. You're going to have a similar type of a thing. The one difference is that when we look at the indicator that's called the envelope, we need to choose the deviation. So for example, if I choose a deviation of 0.5 and click OK, you're going to see this gets really wide, and it kind of defeats the purpose of what we're trying to do with this. And so we're going to go in and we're going to just keep it simple. We're going to keep it at a 0.1 as the deviation for this. Now, a couple things that we want to look at here. One is we're going to use this envelope and 50 period simple moving average as something that's going to tell us the direction that we're going to be trading. So basically, a simple rule is if the price is trading, you know, in the lower range here underneath this 50 period simple moving average, we want to be looking to go short. If it's trading above it, we want to be looking to go long. And that's you know, a real common thing that we look at is when we're trading is what is it that we're going to be using to tell us the overall direction. And so let's zoom in on this and let's take a little bit of a closer look into what the rules would be here. So you can see back in here that we were trading below this moving average, which is a bearish sign because it's showing weakness, that the market is not super strong, and we want to be recognizing that. So the first thing that we want to identify is when the price pulls up into the upper range here. So it runs into this middle area to the upper area. So between the middle line and the upper line. That's going to be kind of the setup. The actual trigger in this is going to be when the price moves below and closes back outside of this range. So you can see that we have a line right here, 1.2746. And you can see what happened after that point. So you can see that we had a rundown of, we'll calculate the pips here. So from this closed candle, closing outside that line down to the low here was about 40 pips. So we could do a quick trade by getting in. Again, this is an hourly chart, so quick is relative, but we could say we're going to look for a 20 pip move or a 30 pip move, and we could put our stop loss outside of the channel here and then move it to a break-even point. So our stop loss, speaking of that, is going to be outside of the channel. So if we got short here and that moved up and it closed outside of this channel, we're going to go ahead and get out of that position. So if we went here and we said we're going to look for just 20 pips, I'll put a plus sign 20, we could have pretty easily gotten 20 pips on that move down, or more, depending on how we did that. And then we're moving back up again, and you can see it hit this line. I don't know, it's maybe a little bit, there we go. We'll zoom it in a little bit more. So we touch this middle line, and then we close outside of the line again. And you can see that this would have put our entry at the close of that red candle. And our stop loss would have been up above this upper line here. And if we looked at the move here, we had it move from about here down to here, about 37 pips it moved down. So we could have set a target to look at gathering about 20 pips, and we certainly could have made a run of 20 pips on this. So we'll put plus 20, make this a little bit bigger. So now we've got two trades, and it ran up 20 pips. You can see that it came back, and you can see that we ran up into this upper range, hit this middle area here, and then it closed below it. So now our entry for this one would have been at the close of this candle, and our stop loss would have been up above the channel line here. And of course, this one ran way down. This one was a big move where it would have ran down, 100 plus pips for us on here. Now, how we manage that, we could have picked up more, but we'll just say for our example here, we said we're going to do 20 pips on here. So plus 20, make this a little bit bigger, 25, click OK, and now we've got that one. Now, we keep watching this and we keep looking, and now we're looking for the next time it moves above into this area here. So once it moves above in this area, then we're looking for it to close below. Again, we're closing below the red line here. Well, this never closed below it, but we did have the price come back and touch it from the high side and then close outside of it. So in this case, we would have taken a long position right here, and we would have put our stop loss outside of our channel. It came down and hit it right there. So if we would have wanted to add an additional position, we actually could have added a trade right here. Moved up, and let's see how far we are on this. So this one, there's our 20 pips. So we could have gotten 20 pips twice on here because of how this moves. So plus 20. Click OK. And we could have gotten plus 20 on the second one. And we had it move up. So let's draw our lines here. So we go from here to here and from here to here. Both of those are 20. So now it moves up. And now we're just looking for our next trade. So it hasn't really pulled back into the channel until right here. It hit it right here, and then it moved back up. And in this case, we didn't close above this line to go in. So it came down, looked like it was going to bounce, but it didn't close up above it. And we started to move down. And now we're coming down from here. Here we closed outside of this channel. So on this one, we close outside of it. And this one, this ran down. Actually, let me move my lines here. So we would have gone short right in there. And we would have had our stop loss up above the line right there. This, on this big wick down, moved 20 pips. In fact, it moved from our entry to the low here about 40 pips. So in this case, we would have gotten a plus 20, and we'll put that on there as a winning trade. Next, this reversed really quickly, so we wanted to get out of that. If not, we would have been in a little bit of trouble. So our next one, we would have bought, coming from below it. We hit this up above it, so we would go ahead and look at going long. I don't know why I don't have an arrow there, but we would have gone long on this one, which means that we would have put our entry right there and our stop loss about right below that line there. And you can see that this, on this very next candle, ran up 50 or 60 pips. So that was a big move to the upside. And so when we look at this, we have our entry to here. We have another plus 20 on that one right there. Moving forward, we don't move back into the line until right here. Doesn't touch it, touches it there, and closes above it right there. So now we've got another entry where we would go long on the close of that candle there, and our stop loss would be below our line. We get a move up here. That's about a 30-40 pip move. So again, we've got another profitable trade here of 20 pips. And plus 20 on here. And we move forward. And we're outside of the line. And we come back. We touch this line. Moving up. We needed to close out. Oh, we came up from down, close it down, up, and then we get into the short right there. So we enter into our short position there. Our stop loss up above the upper channel. And let's see how far we have to move in order to get our 20 pips. We need to move down here a little bit. Okay, so we would have been stopped out on this one with a loss of about 40 pips. So in this case, minus 40 pips. On this trade right here, because we only went down, how far did we go down? We went down about 14 pips on here. So this one will draw a line from here to there. And then we have an entry to go long, and we would be long right here waiting for this to move forward. So as we look at this, we did 1, 2, 3, 4, 5, 6, 7, 8, 9. We won't do this one because it's not closed yet, but this would have been our 10th trade. So we made 20, 40, 60, 80, 100, 20, 40, 60. We lost 40. So we have a 1, 2, 3, 4, 5, 6, 7, 8. 8 winners, 1 loser. Our average win 20, our average loss 40, minus 40. And you know, we net profit on here by 120 pips. So this is a great example of how using a moving average along with price action can help us identify where to get in and where to get out really quickly. Now, if we were to look at a different time frame, we're going to have to make some adjustments to the chart. So for example, if we go down to a 5-minute chart, we're going to have to adjust the deviation. So we'd go to the indicators, we'd go to the envelope, and we'd adjust this to maybe 0.05. Let's see what that looks like. Might be okay. We'd want to test this out and make sure that it's giving us the same information. Actually, we're going to go to 2.5. Let's see if that goes. There we go. So that's a lot tighter, and you can see basically the same concept of what we're looking at here when we look at entering into a trade. So as it comes down and it bounces up and closes outside of that, we're looking to jump in. We may not look for 20 pips. We may look for 5 or 10 pips on a short-term trade like this. So anyway, take a look, if you haven't, at the moving average envelope and how it can help you identify some opportunities to get into a trade based off of identifying the trend, knowing where areas of support and resistance are located, and then really being able to work on getting in and getting out when you're supposed to, taking your wins when you're supposed to, taking your losses when you're supposed to. All right, so with that, thanks for jumping in and listening to this little tutorial on moving average envelopes. My name is Todd, and this is our video for Trader on the Street, and we'll talk to you soon. Thanks, guys.